Good evening, ladies and gentlemen. Welcome to the Rates and Lanes podcast. I am your host, Rico Muhammad. I am being joined by my co-host, Mr. Chuck Snow, and our resident insurance expert, Tommy Ruke. I'm sitting here trying to fiddle around and get my graphics together as we're going here. But if you guys and girls would do us a huge favor, please make sure that you like, share, and subscribe to the show. It helps us out tremendously, gets us out to a bigger and broader audience. We are coming to you guys today on Tuesday, June the 9th, just so we are pre-recording this show. So if you are interacting with us, we won't have a chance to respond. We're recording the show just a little bit early than what we normally do go live at. But with all that being said, and I want to go ahead and welcome my co-host Chuck Snow to the show. Good evening, Chuck.
Good evening, Rico. Good evening, Tommy. Great to be here again, and great to have Tommy Ruke join us. I just need to add something for our listeners. This was supposed to be a live broadcast, and unfortunately, because of some conflicting schedules, we're broadcasting an hour and a half earlier. So, as Rico said, we unfortunately can't take any questions, but we do our best. We've got schedules sometimes that have to be adhered to.
Absolutely. I am trying, man. I am. When you're new to this new technology, it throws you all the way off. All right, I think I got the way. There we go. I wanted to start us off with the I'm being remiss in my duties. Let's welcome Tommy. Good evening. How are you, sir?
I'm doing well, thank you, sir. And I can give him my email address later. If anybody's got questions later, they can email me, and Wonderful. I'll answer them for you. Any questions I have about insurance, this, as you know, I don't have anything to sell except what's between my ears. So I don't.
Good deal.
And I don't charge for that stuff.
And that's exactly why we wanted to kind of get you back on the show really quickly. I'm going to run through these visuals really quickly. I wanted to get a chance to pick your brain a little bit, Tommy, because there's a lot of stuff going on in the industry, and we need it. I wanted to try to get someone
more different things I ever had in my history. I think Chuck agrees with me. There's a lot.
Well, starting out this week, one of the biggest cost factors when it comes to running your operation is diesel fuel, and boy, have we kind of been on a little bit of a ride when it comes to the diesel fuel, but it's going in the right direction. As you can see, way back on April 27th, we were at $5.35. And right now, that is where we are sitting once again on average. It had jumped all the way up to, on average, $5.64 per gallon nationally on average. Now, of course, we know that there were different pockets throughout the country where it may have been a little bit higher than that, but like I say, we're dealing with averages and not specific cases, so to speak. So we see that it's dropped by 17 cents week over week, which is, like I say, it is definitely headed in the right direction. So that's where we stand when it comes to average fuel costs. Chuck, anything you want to add before we move on to different segments?
I'd love to ask Tommy, who grew up in the trucking business. His late dad was an old-time trucker. Tommy, what's the cheapest you ever remember diesel fuel as a boy growing up?
50, 60 cents a gallon. I mean, in those days, my grandfather actually had a filling station. I filled cars up with old gas bubble things and all that. Chuck, it's been, the idea of $1 would be high.
Interesting times we live in, indeed.
Yeah.
And so jumping over to the next chart here, we are going to jump into the dry van segment of the chart. And we are showing, let me see if I can get back over here to my thing. We're showing an average rate per mile. And now with these averages, they back out the fuel surcharge. So this average is without the fuel surcharge baked in. So if you bake in the fuel surcharge, you'll see, but DAT kind of does these charts, and they just want to get the cost of moving freight without fuel. So put that into a caveat when you're looking at these different charts that we're sharing with you guys. So on average, dry van has been averaging out for this week at $2.39 per mile, and that is 7 cents higher than it was this time last week. On average, for dry vans, we're showing that load to truck ratio has been really outstanding, 10.5 loads to truck. So capacity is definitely tight. Rates are definitely reflecting that. And so hopefully you guys out there are making, kind of trying to recover from 4 years of getting kicked square in the hind parts. So now, now is the time that hopefully you're able to get some better, get better rates. And we put the on the chart there. You can maybe able to snap a screenshot of the charts that we sent there, so that you guys can see the top 10 origins by rate per mile on there. You guys can go through and look at that at a later time. But we're trying to do a little bit more, give you guys a little bit more visuals and give you some more information, because a lot of times I know I definitely appreciate visuals. I'm a visual learner, as they say. Chuck, anything you want to add before we move on to flatbeds?
No, keep going, Rico. This is really interesting.
All right. Well, we're going to jump over into the flatbed report, and we are showing that the average mile for flatbeds has just been is the darling of the industry right now. Flatbeds just cannot do no wrong. And if you look at the chart to the right there, and you see it's a steady incline going straight up. So they've been averaging at $2.93 per mile on average. It's up 4 cents per mile week over week, and it's up 37% year over year.
Wow.
So that gives you any indication, and just to let you guys know, just to show you, load to truck ratios averaging for flatbeds is at 69.26 loads per truck.
That's crazy.
And flatbeds have no refrigeration unit on it, so it's actually cheaper to run it, and less maintenance, and cost maybe $10,000 less for the trailer, if not more.
Right. Yeah. And the key takeaways here: all-time record, 18 cents above June 2021 peak. This is 12 consecutive weeks of gain. 79 cents per mile above last year's number from the same time last year, was 79 cents per mile higher. 91 cents per mile above the 5-year average. Load postings are up 76% versus last year. Load volume sit at 32% above the long-term average, and capacity remains tight as peak season winds down. Hurricane season disruption risk is still worth watching. So there's a lot of good information that we got packed into the little visuals there. Let me see. Let us get us out of the way. So if you guys want to snap a screenshot of that and be able to blow it up, we got some very good information in there for you guys on that one. And moving on over to the segment that is kind of near and dear to my heart, the temperature control reefer portion of the report. We are showing that on average, reefer is showing $2.69 per mile on average. That is up 6 cents since last week. It's up 37% year over year, up 27% over the 5-year average, and up 33%. Up 33 cents, not percent, 33 cents since road check. So road check pressures, they had an effect, but we are up even past the road check numbers. So this is just below 3 cents. It's just below the average. Is just 3 cents below the 2021 week 22 record. So we're only 3 cents off from breaking a record, which I truly believe we're going to end up breaking.
Oh, we may have broken it today. You know that?
Yeah, right. 72. We are 72 cents per mile above last year at the same time. 72 cents per mile above non-pandemic 5-year average. Produce hubs averaging at $4.16 per mile on average. Produce hubs up 27 cents and 85 cents above last year. Equipment postings are down, so that once again, equipment posting is down. There are a bunch of loads that are out there, so capacity is really tight. Load posting is up 57% versus last year. Carriers hold pricing power in the Southeast and California lanes. And I tell you, it's definitely, if you look at the charts, it's definitely going up and to the right. And that's a welcome sign that we want to see. Anything you want to add to the charts there, Chuck, for research?
No, this is incredible. It really is.
So it's truly fair to say that the freight depression, recession, whatever you want to call it, has definitely come to an end now. The thing about it, as they say, make sure that we're putting away hay in the barn for a rainy day, ladies and gentlemen. So let's make sure that we, while we have the upper hand, that we are definitely taking advantage and that we are not going crazy. In the good time dancing around and not making sure that we're putting something away for a rainy day, because right now the rain has stopped, but it's going to rain again.
Let me ask you
when this is going to end. You know what? That's the problem.
Let me ask you, experts, and we'll talk about fuel surcharges in a second, but the fuel cost is up that much percentage, if not more. And not all contracts, spot market doesn't have fuel surcharges in most cases. So
right.
There is some variance in that, and not that some of this was needed just to pay for additional fuel.
Absolutely. But on the spot market, you got to understand, if you work in the spot market, you definitely should understand that you have to bake that number into your all-in rate. You need to be baking in your detention, all of that stuff. When you don't have a contract, you need to make sure that you're baking all of those variables in, and you're negotiating while you're operating on the spot market.
You do this, Rico, all the time, but people think that fuel surcharge is something that's given, period. It was coming back pre-80 when you had to justify your rates and file your rates, and you're able to fill a fuel surcharge in without having to adjust your rates. That was 55 years ago. so now it's how well you can negotiate. Now, maybe the lack of capacity now will help us negotiate better fuel charges, and pass that some to the shipper or the broker, or through the broker to the shipper, and that's very positive. But that's the only thing I want to bring out, that we needed some of this just to pay for the extra cost of operating the truck.
Absolutely, and it just goes back to what we always preach here. You got to know your numbers.
Yes,
you got to know your numbers. Backwards, forwards, in and out. You got to understand that, and you have to be conscious of. I know that there's a lot of guys that give pushback when it comes to working with DAT or any of the load boards and any of that type of stuff, and that's fine. But you need to understand the market. You need to understand that the market that you're operating in, so that you can put yourself, so that you know how to negotiate. So it's a whole different ball game when you understand that the load to truck ratio is as high as it is in your particular area. That lets you know that you hold a lot more negotiating power than what you may think. And a lot of times, because brokers, I'm just going to say it, they depend on our ignorance. They depend on our ignorance of not knowing. And a lot of times we help them out by not knowing, and we don't do our due diligence to understand our pricing power. And so so it's not necessarily the broker's job to do you a solid. It's your job to make sure that you are making sure that you are not leaving any money on the table when it comes to that.
If you don't know your operating costs, as you know what, that's your fault, not the brokers.
Right. That's why I brought that up, because they think maybe that's an after fact to think about the fuel surcharge. But that is something the brokers could negotiate up front and have some agreement with that part of it and keep the rate that way. So that's just what I was talking about. I'm sorry, I'm
usually Tom on the spot market.
You're fine, Tommy. And so kind of shifting gears and changing a little bit, Tommy, because I just wanted to I wanted to get you back on. I wanted to ask the question because there's so much going on. There's so much talk going on about all the fraud and theft that is going on in the industry. Someone was just indicted. Now, not someone. There were like 3 people, I think, that were indicted earlier this week in New York for a freight theft ring. They stole millions and millions of dollars worth of freight up in from across different states, and they legitimately went in with found some type of way to hack and get DOT numbers, showed up to the shipper. I mean, literally walked in the door and walked right out with the freight. So when it comes to insurance and making sure that you're protecting yourself, I wanted to ask the question because I didn't know, and I say, well, if anybody would know, Tommy would know. When it comes to this type of cyber thing, with your identity being stolen and stuff like that, where does that fall when it comes to your insurance and your coverage on that? Would that be something that you would be liable for? Would there be a claim that would be, or are there different type of coverages that we might need to explore and look into when it comes to this new world that we're operating in, to make sure that we are kind of covering ourselves?
Well, let's step back for a second before we talk about the insurance part, because of the theft part. If somebody stole your DOT number and the shipper gave it to you, you're not responsible for it. You're not liable for it. The people who are moving, the broker might be, but they are not for a fraudulent thing here because they gave it to a fraudulent. The only time a motor carrier would be liable for the cargo, or even for auto liability, if they took the cargo and gave it to another motor carrier, double brokering.
Okay.
That would be inside. And in that case, they are liable because you can't double broker without broker's authority. So any trucker who takes the cargo in, and then there'd be no cargo policy, and they would be personally liable for it because of MAP 21. I was in a case where the trucker who did this, they found a civil conspiracy theory argument against that trucker because he violated MAP 21. And that could be criminal situations in that part of it. So that's the only exposure. And they would never be responsible for it because the cargo policy doesn't address anything that's not in the insurance care custody control. So since that cargo wasn't in the insurance care custody control, then he or she would not be responsible for it. The only way they'd be responsible for is some of these other things they're doing, and that's a blind load, or they get to the warehouse and they say, hey, by the way, we're full here, so take it down to this other place, this other location I told you to take it. In those cases, the trucker might be liable for giving it up that way, Rico. And that would be where you would have some employee. There's not really coverage for that because cyber theft, the people that hack in and steal things out of your bank account and things like that, that's what cyber theft pays for. Identity theft is personal identity. I don't know any product that's talking about how to cover the motor carrier for having their DOT number stolen. Now, the thing that I think most of the time affects the typical smaller motor carrier we're talking about is not the loss of cargo, is somebody using their DOT number and having 2 or 3 bad inspections under that DOT number, and now they're losing their safety rating. And we'll talk about that in a minute here. I don't know how they're going to be responsible for their cargo if they never picked up the cargo.
Well, it's funny you talk about because DOT, FMCSA, they rolled out the new registration plan, the motors, and boy, I tell you, it's been interesting to say the least. They say I think they're going on 3 or 4 weeks now, and they still haven't been able to register any carriers yet as of yet.
Well, I think they're doing that now, reluctantly. But I went on today and tried to find it, and the crash site. Keith Riddle, who's in charge of that, I was with him 3 weeks ago, right before all this rolled out, and talking about this because my pressure is to get rid of MC numbers. And from the podium, he said, "Tommy, we will get rid of MC numbers soon because that's part of the fraud." And the brokers, this is the broker carrier someone was at. The brokers are crazy. They're looking just at the MC number without looking at the actual motor carrier's activities. And that's an SMS. In fact, we talked about that before the new court hearing that came up from the broker part of it. And just 3 weeks ago about the Supreme Court ruling about broker could be liable, which says they got to do this now. My concern today, Rico, without shifting for what you want to talk about, my concern today is any smaller motor carrier that doesn't have a clean public image, meaning decent CSA scores, different, not out of service when they get inspected, not many out of service ratios that are going to have a tough time to get loads, just like they have for insurance.
I agree. I agree because the brokers are afraid to use a bad carrier.
Right, and right now, and it's a small motor carriers will get hurt, Chuck, because they rely on the big numbers. You know, if you got an orange truck or a blue truck, they figure they got assets there, you know, and they're doing everything right. And no jury's going to criticize those national truck companies. They're public owned and this kind of stuff. It's the one with 5, 8 trucks that I worry about, or 1 or 2. If they're clean or don't have their CSA scores and their out of service ratios and the particularly log violations and things like that. And if they have any English proficient language problem, that's a zero. That just adds claim this point. So, Rico, that's my biggest concern about them keeping to understand that they can't hire drivers that push the envelopes on the road, meaning speeding,
Yeah.
not falling behind, not doing turn signals, and not living to the hours of service rules. It's the old cowboy running today because that motor carrier who hires that driver is going to lose their loads as well as affect their insurance.
Yeah, because when you have 1 or 2 or 5 trucks, you can't afford to lose those points. Where if you have 5,000 trucks, you lose some points. You know what? Not a big deal. You got 4,999 other trucks.
Hiring the wrong driver or not following that driver, disciplining that driver will cost them more, put them out of business because of where we're now. Because every broker now is running scared.
And I was watching, correct me if I'm wrong, Tommy. I know that a lot of people made a big deal, and we even talked about it here on the podcast about the Montgomery case. But for the most part, for the majority of the country, this wasn't really a new development. Brokers were being held liable in a lot of different points. I think there were different, what do they call them, districts or whatever, different districts. Different circuits where
2 circuits says they're liable, 2 circuits liable for them. And we've had some good judgment out of Texas. Texas has 2 or 3 that we looked at who said they could rely on that information. By the way, that Hank Seaton put in there back when CSA first came out. His company on that suit where it drops down. Now paraphrasing slightly, if the motor carrier has not been put out of service, they have the right to operate on the interstate system. They also the caveat that this is not to govern their safety record when we read the stuff in there. And the Texas Supreme Court or the judge of Texas, both cases said that's okay. Motor carriers, as long as they're able to operate on the highway not out of service, you can use them. So we've had some favorable cases. I just think it's, in my personal opinion, it's kind of a knee-jerk reaction in some way, and it's trying to find a shortcut to a long term because we won't know until we get some good court rulings exactly what we need. Because the safety fitness determination, there's none. I mean, I asked this on my classes. I asked the other day, you know, how many motor carriers have the for-hire motor carriers with MC numbers? So let's leave that. Let's quantify just the ones with MC numbers. What percentage of those have a satisfactory score? And people say 20, 30, less than 5%.
Yeah,
right.
They haven't audited in years.
Right. I mean, I got audited when my first year in operation. I've been operational since 2010 with my own authority. I had the one audit for my new entrant audit, and
that's a state audit though, Rico, right? Am I correct?
No, that's the federal. That's the FMCSA. They actually came out. They came out to the house, went through all the files and everything.
Did you get a satisfactory rating?
You didn't no rating. That's the new entry rating. There's no satisfactory.
Yeah, because I remember. Yeah, when we opened up our division, our truck division in Chicago, after 12 months, I had to go to the Illinois DOT with all of our files, and they went through them. And that had nothing to do with a satisfactory rating because it was a state, I believe it was a state audit.
Right. And I'll give you the other side of it. I applied and got a DOT number back in the days because when it first rolled out with MCH-1, where you don't want to just see how it worked. And I got a phone call talk about it. Of course, I told him what I was doing, so he didn't audit anything, and I didn't have any insurance. I never found any insurance. I just did it so I could tell people what you went through the process when I was doing the teaching part of it. So it's various things, but they don't do any audits. Just, I'll give you a little, and I hate to talk about this, but just to give you what might happen in the future. FMCSA just contracted with Blue Wire and G-Log to develop a rating system for all motor carriers.
Who did they contract with?
Blue Wire and G-Log.
Oh yeah,
G-Log.
Genlogs?
Yeah.
Okay.
They have, and they have.
I'm seeing, go ahead, Tommy.
No, and their objection is to rate all truckers. And what it's going to have is when they first come out. I talked to Steve Bryan, who is Blue Wire, the president of Blue Wire,
right,
about it. He's a friend of mine. He's been in many classes, and he says what they're looking at now is you first get in, you get rated, then you'll get a second rating that you've been vented, but you still get what he's going to call a satisfactory water rating when you first get in. Once you pass that until you get some on the highway, then you get an unsatisfactory later. But there'll be two levels of satisfactory. But that'll give us some measurement if they're using their data, their formulas they have developed a long time. I'm sorry, I just want to bring that out. But they promised me to get rid of MC numbers in 1994. Still haven't because I don't know how long this is going to take. I think there's some urgency in this. And I'm talking about the new Modus. They got the cart before the horse. You know the one purpose of Modus?
I think that from what I understand, they trying to update the system so that all of their systems will be able to talk to one another. Whereas before they didn't have that capability with the old system.
No, it's to get rid of any foreign ownership of any motor carrier. Because what their emphasis is and what they do have in place is new vending, where you have, and I've heard some people would update the 150 process or the new app. They hire the people at the airport, TSA people, to screen truckers. So this is why all that first push before the 15th, all that. Make sure your resident person that you have is there. It's the right one. The VIN numbers, you have a street address, not a post office box, not a store. Yeah. And that number, because that number is not that person who's going to be communicating with, who's going to be the principal of insurance of that motor carrier, will have to show their ID, meaning a passport or driver's license ID or legal resident card. And then they will have to take a picture of themselves, and it'll have to be done with ULL location in the U.S. to determine if they're owned and operated by a U.S. citizen. That's the real thing that they worked on to put in place. They didn't do a whole lot of work on all this other stuff.
Well, and kind of just shifting gears once again, Tommy.
I'm sorry, I didn't mean to take that away.
No. You absolutely fine. But I just wanted to ask a question. Give you a scenario. I wanted to give you a scenario, and you tell me about, because I wanted to go back on the theft thing. So a lot of times, like myself, I park at a parking facility. I have a place that I pay to park. It's quote unquote secure because there's a locking gate that we have an app on our phone that opens the gate and everything. But say for instance, if I'm on my way home, I'm under a load, I go home and I park at my yard. I go in, it's secured. It's supposed to be secured, but I come back and my truck is gone.
Truck and trailer and load.
Truck and trailer, load, everything's gone. How does that kind of let's play with that scenario for a second.
Well, you would have coverage if you have physical damage coverage for whatever the truck's worth, no more than the limit you choose and the tractor you choose. The cargo would depend on the form you have and who you deal with. A lot of cargo policies would go ahead and pay that, depending on the nature of the cargo. You hauling vegetables, you might not have the same requirements if you're hauling electronic goods or telephones and this kind of stuff up there. There are some now that says that you have to be attended at all time, which would qualify in the locked area, but would not qualify at your home if you were loaded. So that would be the concern. You just have to read the policy and find out, is there a caveat against theft? All cargo policies cover theft. There's just provision, some of them that you have theft, meaning that you have to do something to prevent it, like vehicle warranty or like a tenant warranty, or limited of some kind of cargo, like alcoholic beverages or electronic goods or stuff like that. So you have to read your policy, and if you're going to take it home, you can't have a policy that would not react. The other thing, if you take it home, if you keep it there for location for more than, depending on their 24 hours to 40 hours, not counting weekends, your cargo policy might not respond either, because you can't, that'd be quoted kind of a terminal, and you can't have it without a separate limit there too. So that would be another thing you'd have to look at the policy. How long was it in one location where cargo is no longer valid? Because there you need to move for an on-site coverage, because you're parked there all the time.
Let me interrupt for 1 sec. It's quite common in the trucking industry today for a driver to go pick up a load, and the bill of lading it's not very informative as to exactly what it is. It could be electronics, but it may say electrical goods with a whole bunch of inventory numbers. And it's almost like they don't want the driver to know what it is or the value, because they're worried about collusion, that he has a friend that's a gang member or involved in one of these thefts. You don't know. A lot of these jobs are inside jobs, as we all know. So that driver hooks up with the best of intentions, and he thinks he's got a cheap load of electronics going from one warehouse to a distribution center, and he takes it home, or he takes it to his yard and he drops it, ends up getting stolen, and turns out it's $500,000 worth of computers or something.
That's a real problem, because electronic goods might be excluded. And so he's going to have to, or she's going to have to find out what cargo is excluded, and make sure if they don't get a definitive check what is, you got to tell the broker, is it this, is it this, is it this, and get that in writing. The biggest problem you also just brought up is that maybe the broker only required 100,000. You said the load's worth 200,000. And you're uninsured. So you also got to make sure that you put on your bill of lading when you sign for it that you're not going to be responsible for more than what the limit they require. So the three things that you could figure out just to get, say, if it's a drop and hook operation, a blind operation, so they don't see what's loaded, you want to make sure that the driver signs shipper, load, and count. And then you also want to put on the bill of lading, or when you sign for it, I'm not responsible for more than what you require me to insure for. And then third, ask more definitive that you give Rico about what's there. I had a case that come back to me that actually put the motor carrier out of business. I've said this, I think, in your program before, that the trucker really has more of exposure for being put out of business than from a cargo loss that's not covered than nuclear verdicts. Because this person picked up a load of things for Westinghouse, for microwave ovens. Not microwave ovens, just parts for it, for Westinghouse. Right. It burned up. Their policy excluded electronic goods. Carrier paid nothing. The broker had a contract that says, if I owe you anything and you don't pay for the cargo, I can offset what the cargo damage was of what I owe you. He'd already factored that, so his factoring company now is suing them for $60,000. Suing them for $60,000, and it wasn't a theft; it was a fire. It wasn't a theft that you were just thinking for. And they're, a Ford truck company losing that kind of revenue, this is what cargo. They've got to, Rico. They've got to ask what's covered, and they got to make sure when they deal with a broker, for the broker to find out exactly what that load is. It's just they can't risk not doing that.
I got a couple of more questions, Tommy, and I guess we'll get ready to kind of wrap this thing up. When it comes back to cargo, I was looking at doing some contracting with FEMA, and to do some stuff with FEMA, they require you to have $300,000 of cargo insurance. My insurance carrier was asking questions about because I guess there's some of that could be considered high risk or whatever if you're dealing with FEMA. Anything that you can shed any light on that? Why what the concern may be from an underwriter's perspective?
Yes, two things. First off, if you want a 300,000 load, you've got to give them what the average is going to be. That's what the premium is based on, not on the max. Here's my average load, but I got, and then even this, because you're going to haul for other than FEMA, right?
Right.
Okay, so you can get a Pacific. You ask for a Pacific customer limit of 300,000. Meaning, when you're hauling from FEMA, you got 300,000. When you're hauling for Joe Blow Pickle Company, it'd be 100,000.
Okay.
That part. And you got to find out what you're going to be hauling, and a lot of that has to do what kind of trailers you're going to haul. This part of it, and it'd be, I don't know anything that FEMA would have that would be something that they would be afraid of from a hazardous commodity standpoint, because they don't have dynamite, they don't have anything. Even the electronic stuff. What do you say, Chuck? I'm sorry.
What we know of, I don't think we know what.
Well, I know, but coming for a disaster location, it'd be things that would be for the disaster location, which would be building materials, maybe some food supplies, some lumber, this kind of stuff. So I would think that go definitive that, and my contract with him is, tell me what you don't want me to haul, and I'll make sure I'll never haul it for them. But I approach them and say, you got a FEMA contract, and you want to haul it, but they're going to require a 300,000 limit. Here's how many loads FEMA has promised me. I'll report those loads, and just have an insurance policy that says when FEMA, under FEMA bill of lading or document of transportation, then you have 300,000, and then have a requirement to things that you don't want to haul from FEMA. So kind of back them into that. You should find a cargo carrier who's willing to do that, because that's good pay, secured loads, usually not the same hurry and all that. So that's good business, Rico.
Okay. Tom, let me ask you another question. I used to be able to, if I was hauling something that I knew we weren't insured for, or the value was greater than my policy, I could phone the insurance company and get a rider on that load. Is that still being done now?
Yes, in fact, Crum Foster have a product that you can call them up and get immediate coverage, both auto liability excess limits and cargo excess limits, no problem.
Okay.
It's fairly available in the marketplace.
That's something the listeners can consider then.
All right, Tommy, this I guess this will be our last question for you. When it comes to right now, there's a lot of discussion going on about insurance limits. There's not enough insurance limits. Wanting to raise the insurance limit. They're talking about trying to raise the limits all the way to $5 million. Saying that $75,000 is not adequate enough. I can concede a little bit on the 70. Maybe it may need to be raised from the minimum of 75,000.
No, it's 750, isn't it?
750.
Yes, I'm sorry, 750,000.
You know when that became effective?
I'm sorry.
You know when 750,000 became effective?
About 30 years ago.
Try January 1st, 1985. People misfigure this because they talk about the motor carrier of 80 and they say 1980. No, 1980 law required it to be raised by in 1985. For the first 5 years of that, it went from 300,000 to 500,000, then 750,000. So sometimes the number. The biggest number I've seen, I know there's plaintiff lawyer in Pennsylvania trying to do $5 million. There's some legitimate discussing about $3 million. I think you're going to find the brokers are going to require higher limits before the government does, because it takes time for the government to do it. And that's the brokers I see are going to require. In fact, C.H. Robinson just raised their run $750,000 to $1 million, $700,000 to $1 million. I think the broker's going to put up a couple $1 million. There's an organization that our friend, by the way, Chuck Rob Mosley is involved in, that the big fleets, and he actually had he was actually at the hearing on the Supreme Court and had a paper he gave to them for their thoughts here, but they want $2 million. His theory is that $2 million they can settle a lot of claims that they can't do for $1 million, and so that's where it helped them. But part of it, Rico, is the bigger companies are trying to force the little guys out of business too by a higher limit. So I think the first push is going to be from the shippers and brokers who are going to require $1 million, $1.5 million to $2 million. The New Jersey $1.5 million is a measurement that they have. I think it's going to be brought up again in Congress. The MAP 21 Act came in, requires the limits to be looked at every 4 years. They looked at it last year and they determined they could not determine a need and could not verify that more was needed. So they passed. But so it's going to be a hot subject but I think the first push is going to be from the brokers and the shippers.
Right. Well, Tommy, I appreciate you taking the time to come and join us. As always, a wealth of knowledge. I appreciate you entertaining and definitely knocking every last one of our questions out of the ballpark. We appreciate
I don't know about it. If anybody wants to email me, you see my name there, and my email address is one word, lowercase like this, at AOL.com. Very simple, AOL.com at my name. So they can send me questions. Anything that have insurance, I get questions all the time about it. I'm more than willing to help them out in this way, Rico. And I don't have all the answers, but I can find out most of them for everything.
Yeah, you're pretty good, Tom.
All right. Well, Tommy, like I say, we appreciate it once again. We're forever grateful for you taking the time out of your schedule to join us.
I was going to ask you, is my hair okay today?
Yeah, better than ours.
Well, you know,
and I'm older than all of y'all.
The thing about it, Tommy, is you don't have as good a barber as me and Chuck. See, me and Chuck got the same barber.
Rico and I, when we go to the barber shop, we want our value, right?
That's right. Yeah. Okay. Bye, guys.
All right. And so, Chuck, let the good folks know how they can find you.
Yeah. If I can help any of our listeners, please send me an email with your phone number, chucksnow280@outlook.com, and I'll be glad to answer any questions you have. And with that, let your backer in a hole for another week, Rico.
All right. Well, ladies and gentlemen, we want to thank you guys for taking the time to hang out with us. You could have been anywhere else in the world, but you hung out with us, and we're always grateful for you doing so. Please remember to like, share, subscribe, comment. It helps us out tremendously more than you ever know. It's free for you. It helps us out tremendous. It helps us out. I can't say enough how much it helps us out. And it doesn't cost you a dime. We won't be spamming you or anything like that. It just helps us get into a bigger algorithm. So we want you guys to continue to stay safe out there, stay healthy, keep it in between the mustard and the mayonnaise, and we'll talk at you same time, same place next week. God bless you and good night.
Catch you on the flip-flop.